Right, right. I mean, that has been the question all along, hasn't it? But this January is the beginning of a bull market or bear market rally. I think we are not going to retest the October lows. We've had a lot of weak economic data and good inflation numbers come in, but recently we've had a bit of a spook with higher than normal jobs than expected, and retail numbers. Of course, the PPI and CPI showed inflation is not going down as quickly as we saw in the last 3 or 4 months. So I think the market's had a bit of a fright. I think the market is largely discounting at least the next two Fed hikes of 25 bips. I think a third one, that probability in June is going up. But I still think the Fed has done most of its aggressive easing, and maybe we have another 75 bips, which is a lot, but they're going to go slowly. I think they know that there is a lagged effect, but I think one of the things that is off the table, at least for now, is recession talk. And also, I'm wondering if investors will start to think about, hey, earnings may not be as bad as we thought. For the last 3 quarters, people have thought earnings would be a disaster. They've been okay.
Well, but Samir, is recession talk really off the table? I look at Walmart, I look at Home Depot and TJ Maxx this morning, and it seems to me like the consumer is strained, looking down market for bargains, right? And TJX said that they might be benefiting from e-commerce players hitting a ceiling on how many shoppers they're drawing. I mean, might that not mean that consumers strained with credit, the savings rate down, could take things down sooner than later?
Yeah, we are still in the recession camp. It's really just a matter of timing. You've got the consumer kind of burning through their savings, which is kind of the remnants of what they got in terms of stimulus checks around COVID, et cetera. Once that runs out, they're going to have a pretty difficult time later this year trying to find a new job, because you're seeing layoffs starting to tick back up. You're probably going to see job growth slow down at some point, too. And what we would focus on is those typical leading indicators, right? Housing is rolling over. You've got a lot of the cyclical sectors in the markets starting to roll over. You've also got, kind of the yield curve remaining inverted. All of that tells us that the recession starts somewhere in the second half of this year. And unfortunately, right now, it seems like it may come amidst the backdrop of higher interest rates.
So, Samira, just to put a fine point on that, it's not the time to broadly buy equities from your standpoint.
No, this is the time to be about as selective as it gets.
So, Barbara, what's going to keep you optimistic about this market? How much do the remaining earnings results matter? We're waiting on Etsy and eBay any second now. NVIDIA later in this hour. I mean, how much, if you're watching the markets, do you need NVIDIA, particularly on the NASDAQ side, to have the kind of upside surprise that we got from Palo Alto yesterday?
Well, I think NVIDIA is not likely to have an upside surprise. I mean, a lot of watchers of NVIDIA think, okay, gaming is probably bottoming somewhere in here. China's been slow. That's reopening. They could have some positive noises about that. But their big engine right now is enterprise spending. And that's a question. You're starting to see some pullback. And so I'm not sure what their forward guidance is going to be all that optimistic about that. But having said that, NVIDIA is a core holding for me, and long term, it's fantastically positioned. But near term, because of the reasons Amir just outlined, there is a lot of uncertainty in the market. I mean, 1 minute it's the Fed, it's inflation, it's earnings worries. And I think that volatility is going to continue. It's going to be very data dependent.